Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. We are thrilled to welcome you all this afternoon and to welcome our guest presenter, Ken Keating. He is an instructor at the Options Industry Council and one of our regular guest presenters. We love having him join us. He's here this afternoon to talk to us all on corporate actions and specifically how they impact options trading. So great topic today. We are trying to get going. Ken, are you with us?
I am, Natalie. Hello, I am. And should I go ahead and share my screen?
Sure, definitely. Thank you so much for being here
Okay,
and for taking the time to talk to us
absolutely.
all about this topic today. And just a reminder, while Ken is pulling up his presentation, everyone live in the Zoom room, if you have questions during the presentation, please feel free to put those in the chat or the Q&A, and I'll get those over to Ken to address at the end. I can see your title slide, Ken, and your wonderful face, so feel free to begin whenever you're ready.
All right, well, thank you. And thank you, everyone, for joining us here today for the last OIC Avant-Garde webinar presentation of the year. So my name is Ken Keating, and I'm a principal at OCC Investor Education, as well as an Options Industry Council instructor. And I'm going to be talking today about corporate actions and options and how they are impacted. But before we get started, we always have to do some housekeeping. And options do involve risks and are not suitable for everyone. So anyone considering trading options should thoroughly read and understand the characteristics and risks of standardized options, also known as the Options Disclosure Document, the ODD. You can visit us at optionseducation.org for a free digital copy, or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies that I discuss here today are strictly for illustrative and educational purposes. All right, we have another separate disclosure because we are talking about corporate actions and we always have to keep all the lawyers at OCC happy. So all the examples provided today are intended to be representative of the types of corporate actions that you might see. But just keep in mind that every corporate action is handled on a case-by-case basis. So just because a merger was handled in one fashion doesn't mean the next merger is going to be handled exactly the same way. It may or it may not, okay? So OCC basically decides when we get the information from the exchanges and from DTCC. Once we get that information verified and confirmed, then we can put out an information memo detailing how the option contracts will be adjusted for that particular corporate action. Okay, so all corporate actions and adjustments are determinations are made in accordance with OCC bylaws and rules and are determined on a case-by-case basis. Okay, last slide for all the lawyers at OCC. These are just the trademarks and logos you'll see throughout the presentation. Okay, a little bit about OIC. Really quick, OIC, the Options Industry Council, who I work for, we are effectively the education arm of our parent company, OCC. So OCC is the Options Clearing Corporation and is the world's largest equity derivatives clearinghouse for exchange-listed options in the United States. So OIC started out as a industry cooperative in 1992 to better educate the public both on the risks and the benefits of exchange listed options. So this is a free service that we offer to the public. All you have to do is go to our separate website, optionseducation.org. There you'll find our complete free online educational offering. We have online courses, we have podcasts, we have videos, we have webinars, we have options related tools. All you have to do is sign up with your email, create a password, and essentially just start learning. If you ever have questions regarding the product, you can shoot us emails at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options related questions. So this too is a free service, but just keep in mind that we are not registered advisors. So we cannot direct you on trades. We can't tell you where you should be investing your money in the options market. We can't critique your trades, but what we can do and what we love doing is talking about options theory, option strategy, also how a corporate action may impact your options position, which we'll be talking about today. So about half the inquiries that we get are people confused about a corporate action that they've been presented with. And if there's ever a corporate action that you're up against, and at some point during your trading, you trade long enough, you will be presented with some type of corporate action, whether it's a merger, a split, a rights offering, a special dividend, and these all impact options contracts differently. So if you ever have questions, you can shoot us an email and we'd be more than happy to walk you through whatever corporate action you're faced with. Okay, really quick slide. This is annual options volume over the last 25 plus years. And this slide was just updated pretty recently. So we're not, 2025 isn't over yet, but we're already up here. We've already cleared and settled roughly about 14 billion contracts, just shy. So we're easily going to go over 14 billion contracts for 2025, which would be a sixth record year for the industry. So, I left the floor in Chicago, the Chicago Board of Options Exchange at the end of 2000, and we were clearing and settling roughly about 2 million contracts on a daily basis. You contrast that today where we're clearing and settling roughly about 60 million contracts on a daily basis, which is it's just phenomenal volumes. And more and more people are trading the product, and they're also trading the product more frequently. Okay, so it just, from our point of view, we just feel very responsible to provide best-in-class options education because, while options aren't overly complicated, there are a lot of moving parts. So hopefully with today's presentation, we'll make one part of the options universe a little more understandable for you. So today is all about corporate actions, kind of the driest, not the most sexy subject, but this is a very important topic. And as I mentioned before, if you trade long enough, at some point you will be presented with some type of corporate action. Okay, so we're going to be talking about corporate actions defined. Then we'll look at the various types of corporate actions. We're not going to go through every single corporate action, but this list probably comprises about 90% of all the corporate actions that you will see. A merger, a stock split, both forward and reverse, a dividend, such as a special dividend, and bankruptcies and trading halts. Okay, so Q&A will be conducted along the way or at the end of the presentation. So time permitting, I'll bring back Natalie, and if anybody has any questions, we can take some time and just answer your questions live. So one of the things that I really want to point out is corporate actions were something that I always struggle with, even as a professional trader. And there was one instance I remember where I was just trading way too many stocks, and one company, there was an election merger, and I had to take action by a certain date, and I didn't just because it flew under my radar. And I ended up losing about 40 grand just because I wasn't up to date on this particular corporate action. And it was just, I still to this day kick myself for it. But it's very important that you keep on top of the corporate actions for the stocks that you are trading. So ultimately, it falls on the investor to be aware of, to do their due diligence and make sure that they're aware of any and all potential, adjustments or news items that are facing the stocks that you're trading, and could likewise adjust the options that you're trading as well. Okay, so corporate actions defined. So simply put, corporate actions are determined by a board of directors at a publicly traded company. Okay, so they're company-initiated events which can significantly impact shareholder investments by affecting the price of those securities, how much ownership percentage you own, et cetera, et cetera. So 90% of the merger, or 90% of the corporate actions that you may come across involve mergers and acquisitions. Stock A buys company B for cash or stock, or a combination of cash and stock. Stock splits, both forward splits and reverse splits. We'll get into some examples going forward on those. Special dividends both being ordinary and non-ordinary, as well as bankruptcy. Sometimes companies do file for bankruptcy and they just go out of business, and that, we'll talk about how that could impact your options position. So corporate actions, typically, they do alter the value or the composition of the underlying shares, which in turn can impact the options that trade under those stocks. Okay, so if there's a corporate action that's impacting one of your securities, what you need to do is you simply go to the OCC website. This is the address www.theocc.com. And if you go to the menu tab, you can go to there's a list for OCC memos. So OCC publishes memos all throughout the day, every single day. And this is kind of what the information memos page looks like. And at the time of this snapshot, these were some of the corporate actions that we had put out during the memos that we put out on corporate actions for that day. Okay, so typically the posted date and the start date and the end date default back for about 2 months. So if there's a corporate action that you want to research that happened maybe a year ago or 2 years ago, you can simply type in the stock ticker, zero out this X date, and hit search, and it'll come up with all of the corporate actions for that particular security over going back years. Okay, so this is how you look up an information memo on the OCC website. This is actually a great, I would bookmark this on your computer, this www.theocc.com. Really great website, lots of information, but primarily the information memo section is, I believe, the most important from an investor standpoint. Okay, so anytime there's an adjustment to the options contract, okay, OCC would determine, once we get that information and we verify it, that information could impact the quantity of the contracts that you're holding. It could impact the trading symbol. In this case, let's say fictitious OICX changes to OICX1. This is really important. Anytime you see a numerical suffix after your option symbol, this is a flashing warning sign telling you that the option is non-standard, meaning that before, if it's just a regular symbol, those options deliver 100 shares of that particular security, in this case, OICX. If it's got a 1 or a 2 or a 3 or a number after this symbol, it means that those options have been impacted by a corporate action and the deliverable is non-standard, meaning it's something other than 100 shares of stock. That's when you need to go to this website, to our website, and search the information memos and figure out what exactly how it's impacting your options position, so you can have a better understanding of what you're trading and what the value of those contracts are. Also, the strike price could be adjusted, the expiration date could be adjusted, the deliverable itself, the unit of trade, the underlying asset for which is the options are trading, as well as the contract multiplier. Okay, so these can all affect, depending on the type of corporate action, these can all impact, these can all change based on the type of corporate action that is being listed. Okay, so now let's look at some examples. So mergers and acquisitions. So, and this isn't an exhaustive look at all types of mergers. There's all kinds of different mergers, but these are the most common ones that you will see. An all-cash merger. Company A buys Company B for $75 a share in cash, okay? Company B's stock would stop trading. If the stock stops trading, the options would also stop trading. And when there's in any all-cash deal, when the companies announce an all-cash deal and it gets finalized, the time premium in those options absolutely evaporates. It goes to zero, meaning that, let's just say I had a long-term view on Company B's stock, and I decided to buy the 80 level calls 2 years out, and I ended up paying $10 for them, okay? If tomorrow Company A buys Company B for $75 a share in cash, okay, and it's finalized, it's a done deal, all that time premium that I paid for out to 2 years evaporates. It goes to zero because this is not going to change. The deliverable now has gone from 100 shares of Company B to $75 per share in cash. It's not going to fluctuate. It's not going to move. Time value, or the extrinsic value of your options, goes to zero. This is why cash takeovers for people who are long options can be very, very painful because all that extrinsic value goes essentially to zero. The implied volatility essentially goes to zero. Any time premium goes to zero, okay? The expiration of Company B's options most likely would be accelerated to the next expiration, meaning that since this $75 a share is not going to change, it's going to, that's, once again, if the merger gets finalized and that's the final number, there's no reason for these options to trade anymore, and all expirations would be accelerated to the next expiration. So in this case, call prices 75 and higher, call strikes 75 and higher would all expire without value, and as well as put strikes 75 and lower would expire without value. If I owned a 70 level call, that call would be $5 in the money, and upon exercise, I would be credited the difference between my effective share price or my effective strike 70 and this $75, okay? In other words, $5 per contract. I would be credited $500 upon exercise in the case of an all-cash merger, okay? So basically, Company B's options in this case would settle to just their intrinsic value. Only in the money options would have any kind of value. Anything at the money or out of the money would essentially expire without value. So now the second type of merger, or the one we're going to look at, is an all-stock merger. Now, one particular company, in this case OIC, buys OICX in exchange for 0.5 shares of OIC for every 1 share of OICX owned. So before the merger, the options delivered 100 shares of OICX. After this merger, now the deliverable would change from 100 shares of OICX to 50 shares of OIC, okay, per contract. Sorry. Come on. There we go. Sorry about that. So because the deliverable is now something other than 100 shares of stock, it's gone from 100 down to 50. That's why you see this numerical suffix after the option symbol, indicating that the deliverable now is not 100 shares. It's non-standard. It's something other than 100 shares, in this case, 50, okay? And if that's the case, adjustment details would be found in an OCC memo, which you can obtain by visiting us at www.theocc.com. Now, there's another type of merger. It's a stock and cash merger. OIC buys OICX for 0.5 shares of OIC for every 1 share of OICX owned, plus $3.50 in cash, okay? Once again, as the deliverable has changed to something other than 100 shares, you would see your symbol would go from OICX to OICX1, and the deliverable would most likely become 50 shares of OIC plus $350 in cash per contract. And once again, adjustment details would be found at the OIC website. So cash in lieu, in some cases, cash is paid in lieu of fractional shares, okay? If OIC buys OICX in exchange for 2/3 a share, okay, for every whole share that that you own in OICX, now the deliverable would become 66 shares of OIC plus 2/3 of a share of OIC stock in cash that would yet to be determined. Okay, so essentially what happens is if there's any fractional shares, the exchange agent goes out, bundles up all the fractional shares. There's usually a process involved, and they sell them out in the open market. Once they determine what that value is, OCC would publish a memo and say, well, the deliverable now is 66 shares of OIC plus $2 in cash, something like that, something this cash in lieu would not change at all. It would be fixed, okay? The only thing that would move around would be the 66 shares of OIC, the acquiring company. Also keep in mind that adjustments are made on a single contract basis. It doesn't matter whether you own 1 contract, 10, or 1,000, okay? The adjustment's the same. It doesn't change. You can't aggregate contracts and get to a different deliverable. Okay, it's always based on the single contract value. In this case, 66 shares of OIC plus 2/3 of a share of cash in lieu yet to be determined. Once again, cash in lieu and cash values are non-fluctuating and will remain fixed once they are announced, and they won't vary with price changes in any of the securities. So once there's an OIC memo published, typically you would see there would be a pricing formula in that memo telling you allowing you to use that formula to determine the moneyness of your options. Okay, so in this case, OICX1 equals 0.5 shares of OIC plus $3.50 in cash. If OIC were trading for $100, okay, the formula would be 0.5 times 100 plus $3.50 in cash. When you do the math, that gets you to $53.50. Okay, so meaning that an OICX1 $50 call wouldn't be an at the money call. It would actually be in the money by $3.50. It's like you would have to figure out what your underlying is at any given time based on this formula. If you own a 50 call, if I own the OICX 150 call and I did this formula and my underlying stock price is 53.50, well, I know that my option is $3.50 in the money. It's probably trading for a little bit over, with extrinsic value and how much time's remaining. But very important part of the memo section is the pricing formula that goes along with any type of corporate action. All right, so those are mergers. Now let's look at stock splits, okay? So essentially, issuers of underlying stock may decide to forward split or reverse split their shares for a number of reasons, okay? And this impacts the shareholders on the X date of the split, okay? So typical forward split, stock's trading for 200 and the company decides to come out and for whatever reason, maybe the stock price is too high. They want to make it look a little more attractive. So they're going to forward split their shares 1-for-5, meaning that for every share that I own of this particular stock, I'm now going to get 5 shares. Okay, so stock was trading 200 before the split. It's going to split 5-for-1. Okay, the stock is going to open up at 40 on the day of the split. In other words, it's going to go down by a factor of 5. But now I'm going to receive 500 shares of this particular stock. If I owned 100 shares of a $200 stock, that's $20,000 worth of stock. Now, after the split, I'm going to own 500 shares of a $40 stock. It's still $20,000 worth of stock. Nothing economically has changed. It's just that now I own a larger number of shares at a price that's much lower. Okay, but economically, nothing's really changed. You can kind of think of it like if you took a pizza and you could either have somebody offered you, well, you can have this whole pizza, or I could take this pizza and slice it up into 8 slices and give you that too. It's still a whole pizza. Okay. It's just now it's sliced into 8 different pieces. Nothing's changed. It's still a whole pizza. Okay. So, stock, once again, a company might decide to forward split their shares to make maybe the share price gets to a really high level. And now, maybe they can generate more interest from retail clients if the share price is trading 40 versus 200. It has no economic, the economics of the company are completely the same. Nothing changes. It's just there's going to be more outstanding shares with the stock, at a price of 40 rather than 200. Now, the one that does throw everybody off, and we'll get into an example of this, is the reverse stock split. Okay. Now we're going to look at a 1-for-5 reverse stock split. So somebody might decide to reverse stock split their shares if it gets down to a low enough price. Okay. Now let's say the stock was trading for, I don't know, $5 and all of a sudden it went down to 75 cents. Well, there are listing standards to have your stock trade on a national exchange. And if you fall below those listing standards, the exchange might not allow you to list on their exchange. So a company might decide to reverse split their shares, in this case 5-for-1. So on the date of the reverse split, the stock's going to go from 75 cents now up to 375. Okay, it's going to go up by a factor of 5. But because it goes up by a factor of 5, the deliverable for the options gets reduced by a factor of 5. We'll look at an example going forward. But if I owned 100 shares of a 75-cent stock, that's $75 worth of stock. Now, after the split, I'd own 20 shares of that same stock valued at $3.75. That's still $75 worth of stock. 375 times 20 is $75. Nothing economically has really changed. It's just now there's a lesser number of shares that are trading at a higher valuation. And once again, companies might do this to make their stock look more, healthier than it actually is, and also to meet a listing requirement and mitigate against being delisted from a national exchange. Okay, so stock splits, there are forward splits. For forward splits, there's forward even ratio splits and forward odd ratio splits. So even ratioed splits are pretty straightforward, okay? Stock gets split 3 for 1, 2 for 1, 4 for 1. So the post-split stock price is going to be lower than the pre-split stock price. Shareholders are simply going to own more shares after the split than before. The share price and option strike price typically gets reduced by the ratio. We'll look at an example going forward. And the number of contracts increases by the amount of the ratio. There's no change to the options trading symbol because the unit of trade is still going to be 100 shares of stock, and the multiplier is going to be the same. For an odd ratio split, a 3 for 2, a 5 for 4, a 7 for 5, post-split, the stock's going to be trading lower than the pre-split strike price, or the stock price. And the stockholder is simply going to own more shares after the split than before. The share price and the option strike price will reduce by the amount of the ratio. We'll also look at an example of this. And the options trading symbol, because the deliverable will change from 100 shares to something more than 100, then you will see that numerical suffix after the option symbol indicating that the deliverable is non-standard. Once again, the reverse split, just the opposite of the forward split. In this case, here's some examples, 1 for 5, 1 for 50, 1 for 500. In this case, the post-split stock price is going to be higher than the pre-split stock price. You're just simply going to own fewer shares at a valuation that's, whatever, times greater by the amount of the split. Okay, if a stock's reverse splits 1 for 5, I'm simply, before the split, my options delivered 100 shares of stock for that particular security. After a 1 for 5, now it's simply going to deliver 20 shares, okay? Because the stock's going to gap up by the amount of the split. It's going to be like a factor of 5. The deliverable for the options gets reduced by a factor of 5. So once again, economically, nothing really changes. The options trading symbol will change because the deliverable is going to change, but your share price, your strike price, the number of contracts you own, and the multiplier is all going to stay the same. And we'll look at some examples of this. Once again, cash in lieu in some instances can be paid in lieu of fractional shares. And OCC would publish an information memo where you'll see a pricing formula used to calculate the effective share price, so you can always determine the moneyness of your options at any given time. Cash values, once again, are non-fluctuating. They remain constant. And they don't, the cash values do not move depending, regardless of what the share price does. Those are fixed. In the case of reverse splits or other adjustments, there can be multiple corporate actions on the same security. A company could declare a special dividend, reverse split their shares, and then get taken over. Okay, I've seen, I think the most amount of corporate actions on one option, I think it was 5. So it's sometimes it can get pretty involved, but just know that adjusted options can be adjusted in the future, many times over, depending on, how many corporate actions that the stock is subjected to. Rounding. Sometimes fractional shares are not paid in cash. Sometimes the company might decide to round fractional shares either up or down. Okay, that comes from the company itself, not OCC. OCC simply conveys that message to the public in an information memo. So we don't make that decision to round shares up or down. the decision to round shares up or down is made at the company level, as well as the idea to pay cash in lieu of fractional shares should that be necessary. Now, for corporate actions, this applies to all corporate actions, but keep in mind, OCC and the exchanges typically do not put trading restrictions on the adjusted options, okay? Some brokers may input trading restrictions to manage their operational risks on clients. So if there's a corporate action that happens and you are long an options position, you more than likely will be able to sell to close it, or if you're short it, buy to close it. But more than likely, you won't be able to. Well, once again, depending on your broker, most likely you would be subjected to closing only restrictions. Once again, that's done at the broker level, not from OCC or the exchanges. So you'll want to speak with your trading or brokerage firm for more information. Should you be presented with some type of corporate action and find out if closing only restrictions do exist for those products. All right, so now let's look at some examples of some simple splits. Okay, so the most basic split in this case, a 2-for-1 stock split. So this is an even split. Your number of contracts is going to increase by the number of the factor of the split. So in this case, multiplied by 2. So if I own 1 contract before the split, after the split, now I own 2 contracts. The deliverable would be unchanged. It would still be 100 shares of stock per contract. The strike price would be divided by 2. The multiplier would be unchanged. It would still remain 100. And because the deliverable is unchanged, it stays at 100. The option symbol would not change. So let's look. Let's just say I'm long an OICX DS50 call. Let's just say for example purposes, the stock is trading for 50. Okay, so essentially before the split, I own 1 at the money call. Okay, after the split, the stock is going to go from 50 down to 25. Okay, so now with the stock trading at 25, instead of owning 1 of the DS50 calls, I'm going to own 2 of the DS25 calls. I'm still long the at the money calls, except now I just own twice as many calls at a strike price that's half as much. Okay, the deliverable is still 100 shares of stock for each. The multiplier is still going to be 100. And because the multiplier or the deliverable is going to be the same, the symbol doesn't change. OICX will stay OICX both before and after the split. So before the split, I'm long 1 OICX DS50 call. After the split, I'm long 2 OICX DS25 calls. And this also makes perfect sense. Let's just say you were going to exercise, let's say we were at expiration, for whatever reason you want to exercise this call. Okay. Well, pre-split, if you were to exercise the 50 level call, you would pay your strike price times 100 and take delivery of 100 shares of stock from 50. Okay. You pay $5,000. Well, if you're going to exercise your 25 level calls, well, now you own 2 of these. So you would pay your strike price times 100. That's 2,500. But now you're going to do it 2 times. So 2 times 2,500 is 5,000. Nothing changes economically. You're just long 2 now at the money contracts versus 1. Okay, so economically, nothing really has changed. Now, the odd stock splits, these do happen. They happen less frequently, but in an odd stock split, the deliverable is proportionally increased. The contract multiplier is proportionally increased. The option symbol is adjusted. It'll have that numerical suffix after it because the deliverable is something other than 100 shares of stock. Your strike price will proportionally be decreased, rounded to the nearest penny. And once again, adjustments are not usually made to the number of outstanding contracts. You're still going to have the same number of contracts. They're just going to deliver more shares and your multiplier is going to be higher. Okay. So typically in an odd split situation, after the odd split, you might see standard option contracts that deliver 100 shares that will be relisted and trade alongside the split adjusted strikes. Okay, so what does that look like? So let's just say we have a stock and it splits 3 for 2. So in other words, for every 3 shares of stock that I owned I'm sorry, for every 2 shares of stock that I own before, I'm going to be getting 3 shares. Okay, so your number of contracts remains the same. Your multiplier, your deliverable gets multiplied by this, in this case, 1.5. Okay, that's the ratio. 3 divided by 2 is 1.5. Strike prices are going to be divided by 1.5. Your multiplier is going to be multiplied by 1.5. And because the deliverable is now something other than 100 shares of stock, in this case, it would be 150. Your option symbol would be adjusted as well. So looking at the same example, if we were owning a OICX DC50 call before the split, it delivered 100 shares. Now, after the split, OICX, the 50 level strike, is going to be impacted by the split ratio, 3 for 2. When you do the math, it gets you to 33. You're going to be long a 33.33 strike, okay? But those options adjust. This option is the right to buy 150 shares rather than 100, okay? If you do the math and if I were to exercise this 50 level call, I pay my strike price times 100 or $5,000 to take delivery of 100 shares of OICX. Post split, if I were going to exercise this, I would pay my strike price times 150. Okay, that's still $5,000 roughly. And now I'm going to take delivery of 150 shares of OICX rather than 100. Okay. And because the deliverable is something other than 100 shares of stock, the symbol changes from OICX to OICX1. Once again, that 1 is that flashing warning sign warning you that you need to do a little homework. Go to the OCC website to figure out how your options contract is being impacted. And, in this case, the deliverable, due to the odd stock split, the deliverable has increased from 100 shares to 150. Before the split, I was long an OICX DC50 call. After the split, I'd be long one OICX1 DC33.33 call. But once again, economically, nothing's really changed. Now I'm going to talk about reverse stock splits, and this is the one that always throws people off, and you'll see why. So in a reverse stock split, the one thing you got to keep in mind, the only thing that changes in a reverse stock split is the deliverable and the option symbol. Your number of contracts, your strike price, and your multiplier all stays the same. Economically, nothing really changes, okay? The only thing that's going to change is the deliverable and the option symbol. So once again, if there is a reverse stock split, you may see standard options listed a few days later that will deliver 100 shares that'll be trading alongside the non-standard options that have a numerical suffix after it. So you want to be really careful that you're trading the right particular contracts that you want, rather than opening some new contracts in non-standard options or standard options that you didn't intend to in the first place. So in this case, we're going to look at a 1-for-5 reverse split. Okay, so in a 1-for-5 reverse split, the deliverable gets reduced, gets divided by a factor of 5. Your strike price remains the same, your multiplier remains the same, and because the option symbol changes from 100 shares, in this case down to 20, the option symbol will have a numerical suffix against it. So before the split, let's just say stock was trading for $1 and we owned the 1 level call, okay? Well, before the split, it was the right to buy 100 shares of stock at $1 with the stock trading 1. It's an at-the-money call. After the split, the stock is going to go up by a factor of 5. Okay, so now, because the stock's going to go up by a factor of 5, the deliverable gets reduced by a factor of 5. So instead of owning 100, or instead of having my contracts deliver 100 shares with the stock trading 1, with a strike price of 1, now it's going to deliver 20 shares with the stock price at $5. Okay, my strike price is going to still remain 1, and this is where it gets confusing. The stock's going to open up at 5, and people were going to say, "Well, God, I own the $1 call. This $1 call isn't $4 in the money. It's not automatically $4 in the money. It's still exactly at the money, okay? Because you have to do the pricing formula that would be shown in a memo. But in this case, you would have to take the price of the stock and multiply it by 0.20 to get your effective underlier. It would still be $1, okay? But remember, that's because these contracts, instead of delivering 100 shares of stock, where they did pre-split, post-split, they're only going to deliver 20 shares. Okay, so once again, keep in mind that because the stock's going to go up by a factor of 5, the deliverable gets reduced by a factor of 5. Theoretically, nothing changes. If you owned the at-the-money contracts before the split, you're going to still own the at-the-money contracts post-split. If you own the in-the-money contracts pre-split, you're going to own in-the-money contracts post-split, unless the stock makes a big move. And likewise, if you own the out-of-the-money calls pre-split, you would still own out-of-the-money calls post-split. Okay, so pre-split, we're long one $1 call with the stock trading $1. The calls are at the money. Post-split, we're going to be long the OICX1 DEES1 call with the stock trading $5. Once again, these are still the at-the-money calls, okay? This $1 call isn't miraculously $4 in the money, okay? It simply means that the contracts deliver 20 shares trading for 5 rather than 100 shares trading for 1. It's still $100 worth of stock, okay? Let's just say I look at on my option screen. This is where people get in trouble. They look on their option screen post split and they see that, well, God, the $5 calls, the at the money calls are trading for a nickel, and there's a month to go. So I'm going to buy hundreds of these. It seems like free money, right? Well, they're not the at the money contracts. Okay. Where does this stock price have to be for my $5 OICX1 calls to be at the money? Well, you have to take your strike price, divide it by 0.20, which is the share ratio. When you do the math, you get to 25. That stock would have to rally from 25 from $5 up to 25. In other words, it's $20 out of the money for these $5 calls to be at the money options, okay? And this is where investors get into trouble because they think there's free money out there and they think I can buy thousands of these at the money calls for a nickel, and they're really buying calls that are $20 out of the money, not knowing that they've been adjusted and there's a different deliverable here. So this is where it's very important to understand what you're trading, because I'm going to tell you right now, there's not a lot of free money out there, okay? If it's priced weird and it looks strange, there's probably a very good reason for it. And once again, if that option has a numerical suffix after the symbol, you're going to have to do a little homework and figure out why. But there are some investors, they choose to shoot first, ask questions later, and then they end up losing money. And, it always happens. We see this every time a big reverse stock split happens. Invariably, there are investors that go out and, buy these options because they think they're just stupidly cheap, and they're really not. They're priced. And, these $5 calls are, in fact, not at the money options. They're $20 out of the money. Okay, so now let's get into dividends. So essentially, a cash dividend is a distribution made by the company. If the company decides to, they don't have any good uses for the cash, oftentimes they'll return cash to their shareholders in the form of a dividend. Ordinary dividends do not warrant an adjustment because they can be priced into an options position. So maybe a company pays a 50-cent dividend every quarter. They've been doing it for 10 years. That can be priced into an options contract. OCC has published guidelines. If you go to the information memo section from our website and look up memo 54262, this is a really good memo that reads like an FAQ on dividend adjustments, why a stock or options might be adjusted for a dividend and why they might not be. Okay, so typically non-ordinary dividends are special dividends. Okay, these are typically one-time payments. All of a sudden, the company has a large amount of cash and they just decide to do a special dividend. If this is the case, This can't necessarily be anticipated by the options market and be priced. So in this case, in the case of a special dividend, if it's determined that it is a non-ordinary dividend, OCC would publish a memo and make an adjustment. The preferred method for making a special dividend adjustment is to reduce the strike price by the amount of the non-ordinary dividend, okay, if the exact price is known of that dividend. The other method is to add the dividend to the deliverable, okay? If all of a sudden maybe they pay a $5 dividend and there's $2.50 strikes out there, you can't lower 2.5 strike by $5, right? You'd have a negative strike price. Because of that, the strike prices wouldn't be lowered down by the amount of the dividend. It would just be added to the deliverable. The deliverable would be something like 100 shares of this particular stock plus $5 in cash. Okay, so here's some examples of a special cash dividend where we would lower the strike price. Okay, so OICX announces a special cash dividend of $2.50 per OICX shares held by stockholders. Your number of contracts is going to stay the same. The deliverable is going to stay the same. On the day of the dividend, when it goes ex-dividend, the stock is going to drop by the amount of the dividend, $2.50. The multiplier is going to stay 100. The symbol is going to remain OICX. So before the dividend, you would own, let's just say stock was trading 50, and you own the at-the-money OICX DS50 call. After the dividend, the stock's going to drop by 250. You're now going to own the OICX DS47.5 call. It's still the at-the-money call. You're not going to be all of a sudden lose $2.50 because of this the strike price because the stock dropped by the amount of the dividend. Okay, this is how option holders are made whole by a special dividend, typically by a strike adjustment. Now, let's look at an example where there's a special cash dividend that's particularly large, and we can't lower, once again, using the example before, where let's just say this company decides to pay a $5 special dividend, and the lowest strikes out there are 2.5s. Well, you can't lower the 2.5 strike by $5 because you'd have a negative strike. Now, the dividend would be added to the deliverable. Okay, so the number of contracts you own would still stay the same. The deliverable would change from 100 shares to 100 shares plus $500 in cash fixed. And because that dividend, the deliverable is something other than 100 shares, you'd see that numerical suffix by your option symbol. Before the dividend, you'd have the OICX DS10 call. After the dividend, you'd have the OICX1 DS10 call. Your multiplier would remain the same, it'd still be 100, and the option symbol once again changes because the deliverable goes from 100 shares pre-split to 100 shares plus $5 or 500 per contract. So let's look at OICX and OICX1 at expiration. If all the options on the day of the split change to OICX1 with the adjusted deliverable, oftentimes the exchanges would add standard contracts after the split. So you would have OICX that deliver 100 shares. I know this gets a little complicated, but bear with me. You'd have standard OICX options that deliver 100 shares trading alongside OICX1s that deliver 100 shares of stock plus the $5 special dividend. Okay, so once again, that numerical suffix, that warning flashing symbol to make sure that you do a little homework and figure out why that's the case. So let's just say the stock closed at $7.50, and we look at the DS10, the regular DS10 OICX calls. Well, they're $2.50 out of the money. They have no intrinsic value. Whatever value they're trading for is probably time premium. On the other hand, the OICX1 DS10 calls are in the money by $2.50. Why? Because they deliver 100 shares of OICX trading $7.50 plus $5. Okay, when you do the math, that's $12.50. The DS10 calls would be $2.50 in the money. So these would be deep in the money. These would be out of the money. Okay, so yeah, as you can see, you have to be really careful of what you're trading. And once again, that numerical suffix, I can't emphasize this enough, is that flashing warning sign indicating that the deliverable is something other than 100 shares of stock. Okay, so now let's talk about bankruptcies. So bankruptcies do happen. Sometimes companies file for bankruptcy, and the shares still trade or are halted for trading, but continue to exist. So the options still settle for the underlying shares. Okay, so if this trading has been halted in the stock, then the options will also halt as well. The stock's not open, the options won't be trading. If all of a sudden the stock goes low enough and it's about to declare bankruptcy, the shares, it might not meet listing requirements, and the shares may move over the counter from a national exchange to the OTC market, or the pink sheets as they're known. Okay. Once again, in a bankruptcy type scenario, brokers might impose closing only restrictions on option holders. You want to check with your broker if that's the case. But typically, OCC doesn't put any contract exercise restrictions on long contract holders in the case of a bankruptcy. If the courts come out and determine that the shares are worthless, if a bankruptcy court comes out and cancels the shares, that effectively wipes out the equity for those shares, making the equity worthless. In that case, all calls would expire worthless, and anybody who owned a put would be able to exercise their put, receive 100 times their strike price, and have to deliver nothing to the other side. Okay, but that's only if a bankruptcy court comes out and cancels the shares. Now let's talk about trading halts. There are various reasons why a stock might halt trading, and this could be government mandates, it could be news company news announcements, large intraday moves, various reasons why a stock might halt trading. Typically, these are implemented by the stock exchanges, and halts can last for hours, they can last for days, weeks, or even months. I remember years ago, there was one particular company where it was halted for months. And we'll get into some of the nuances about this. But once again, keep in mind that OIC does not place contract exercise restrictions even during trading halts. Okay. If a trading halt does not, even though the trading halt does not preclude the rights of the buyers and sellers of options. Okay. So people who own those options still have the rights, but not the obligation to buy or sell those shares of stock. And the sellers of those options are obligated to either sell shares or buy shares in the case of puts, even though the stock is halted. If the stock is halted, OCC may remove the option from exercise by exception processing. What's exercise by exception? Typically, it's a courtesy to our member firm. So options at expiration that are typically a penny or more in the money get automatically exercised unless the holder of that option sends affirmative exercise instructions to their broker not to exercise them. Okay, so typically options that are a penny or more in the money get exercised. If a stock is removed from exercise by exemption, the only way to exercise those contracts, if your expiration comes up, is to manually exercise those contracts. So if all of a sudden the stock is halted and your expiration, let's say a stock has been halted for weeks and today's expiration, and I want to exercise my calls or puts, okay, I need to make an independent determination whether I want to exercise those calls or not by my broker's exercise cutoff threshold. And I would need to make an independent determination to exercise those contracts. Okay, they will not be automatically exercised if it's been removed for exercise by exemption. OCC puts out memos on Tuesdays and Thursdays. Every Tuesday and Thursday, we put out a list of stocks that go on this halted list. And if they're halted, they will be taken off exercise by exemption. So this memo comes out every Tuesday and Thursday at 10 a.m. Central Standard Time. It comes out like clockwork. So you can see what stocks have been taken off automatic exercise. Once again, if you decide to exercise, the investor will need to manually do so through their brokerage or trading firm. Now I'm going to get into kind of like a nuance here. The stock I was talking about, this was like 3 years ago. The stock had been halted for months. And the stock had actually traded from, I think it was like 35 down to 30, down to 20. I think it halted at $10. And there were a lot of people that were long puts because they thought this company was just they were having counting irregularities. They thought the stock was basically going to go bankrupt, and they owned puts. Well, their expiration came up, and they didn't own the physical shares to deliver against those puts. So remember that once again, OCC doesn't put contract exercise restrictions on long contract holders. Your broker, however, may put contract restrictions on you if you can't fulfill the terms of those contracts, meaning that, let's just say I own the $20 put, stock halted at 10. Okay, my expiration is today. If I want to exercise that contract, okay, I'm free to do so in the eyes of OCC. I would receive my strike price times 100, or in this case, 20, or I'm sorry, $2,000 per contract. And in return, I'd have to deliver 100 shares of stock upon exercise, meaning that I would be naked short the stock. If the stock is halted and it's been going down for a while, this particular stock, there was no stock to borrow. So brokers couldn't physically borrow the shares to lend to the people that wanted to exercise their puts. They didn't allow their investors to exercise their puts. And even deep in the money puts expired worthless. Imagine like having a winning lottery ticket. You did the right thing. You bought puts because you thought the stock was going to go down. And now you've got these golden handcuffs on because your broker won't let you exercise because you don't have the physical shares to deliver against the puts you want to exercise. So it doesn't happen that often, but it's kind of a nuance that you want to keep in the back of your mind. If the stock reopened, it would be no problem because you could either one, sell out your puts into the options market, or buy the actual stock and then exercise your puts and have the physical shares against your puts. But in the case of a halt, the shares aren't trading, the options aren't trading. The decision to exercise is going to, for you to be able to carry a naked short stock position is going to have to be between you and your broker, and it's going to be determined by the borrowability of those shares. So I remember there were some people that were long, oh my God, they were long like 40, 35, 30, 25, 20 level puts with a stock that closed at $10 that were deep in the money, and they weren't allowed to exercise because their trading firm couldn't find the borrow and wouldn't allow them to carry the naked short position. Okay, so it does happen. It doesn't happen that often, but it's just a nuance you need to be aware of. Okay, so once again, if the shares are halted, you can't trade out of the stock. These are the statistics that OCC has kind of over the years. These are pretty consistent. So about 72% of options are closed out ahead of expiration, meaning that people who are long the contracts sell to close them. People that are short them buy them back. Okay. Only about 6% of options are ever really exercised, and the remaining 22% expire worthless. In a halt, the only way to monetize the value of your options contracts is to exercise them. Okay, so once again, you would have to make an independent determination if it's been taken, if it's halted and it's been put on that exercise by exemption list. You'd have to make an independent determination through your broker to manually exercise those contracts if your expiration comes up. Okay, so this is basically a kind of a cheat table. It just kind of shows you the different types of corporate actions here. Once again, just because this is typically how corporate action is handled, but just remember that every corporate action is still handled on a case-by-case basis. So just because a merger was handled in one form doesn't mean the next merger is going to be handled in exactly the same way. Once again, the only way to determine how your options are going to be impacted is to go to the OCC website, figure out, look at the expiration, I'm sorry, the corporate actions memo, and figure out, where you stand in terms of the contracts you own and how they're being impacted. And once again, if you ever have questions, you can always shoot us emails at options@theocc.com Monday through Friday. And we'd be more than happy, like I said, to answer your options related questions. About half the inquiries we get are regarding corporate actions. They can get a little involved, and trust me, like even as a professional trader, sometimes they would hang me up and make my head spin a little bit. So you're not alone if these kind of confuse you a little bit, but we're always happy to clear up any confusion that you might have. All right, so some takeaways. Corporate actions, once again, are publicly traded company-initiated events which can significantly affect the value of the underlying shares. And if the share prices are being impacted, they may require adjustments to the related options contracts. All options contracts are made on a case-by-case basis by OCC. Once again, OCC receives the information once, just because you see a news story about a dividend on Bloomberg or CNBC does not mean that those options are going to be automatically adjusted at that time. We have to get that information from the exchanges as well as the Depository Trust Corporation, DTCC. Once we get verification from both sources, now we can put out an information memo that will detail. Once we put out an information memo, that will be the definitive way that those options will be adjusted, and which will be determined through an a corporate actions memo. If an adjustment is warranted, details of the adjustment will be posted on OCC's website. So once again, try and bookmark that OCC information memos section. And once again, questions regarding any specific corporate actions should be directed to our education desk. You can reach us at options@theocc.com. Once again, Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. And we'd be more than happy to clear up any confusion that you might have regarding corporate actions. So that is the end of the presentation. I know we're right down to the wire. I'm happy to do some Q&A at the end if people want to stick around for a little bit, but here's our information. For more information regarding our website, you can go to optionseducation.org to view our full online educational offering. Send us emails at options@theocc.com with any and all of your options related questions. We also have a YouTube and a Facebook presence and presence on X. So with that, I'm going to bring back Natalie, and thank you for joining us here today, and I appreciate you taking time out of your busy schedules to attend this webinar.
Thank you so much. That was a huge amount of information. Thank you for going through all that. Yeah, please take a drink. You talked for an hour straight. So that was wonderful. I do want to call out that really great, helpful summary chart slide that you had towards the end. Obviously with the disclaimer that the fact it's not going to encompass every possible scenario, but it's a great image and a good, good takeaway for everyone here. And you all will get, again, a link tomorrow with the recorded replay. So you can watch this as many times as you want, pause it, screenshot this, you'll be able to do that. And great that Ken put all the contact info. You can reach out to the OCC. They're a fantastic resource, and we certainly encourage you all to reach out to them, particularly on this topic, because as Ken mentioned, it does come up a lot, and they are well versed in it. We are, as you noted, Ken, at our time stop here. So if anyone does have questions you think of later, feel free to reach out directly to Ken at the OCC or to us over at Avant-Garde. We're getting a shout out here from one of our attendees. Thank you for this interesting but important presentation. You are welcome. Thanks for listening and for engaging. We appreciate it. I'm just going to wrap up here as a reminder. Come check us out at avantgardetrading.com. Hit that education tab. Make sure you come back and sign up for all of our educational webinars, and we will have Ken back with the OIC sometime in the first quarter. Until then, I hope everyone has a lovely holiday season, good trading, and we'll see you back at the next webinar. Thank you, Ken, for taking the time. We appreciate it.
Well, yeah, thank you, Natalie. Happy holidays, everyone. Have a great rest of your week.
Thanks all. Good trading.